All right, good morning, California. Good afternoon, Midwest. Today, the First Bank Center for Family Businesses explores the question, will living in the red or blue side of the aisle impact your investments? I'm Mike Vanderveld, and I'll be your facilitator. Before we get started, allow me to cover just a couple of logistics. The lines are muted, but at any time, please send us your questions through the webinar tool. This session will be recorded, and we'll place it on first.bank soon after we end. That's right, first.bank is the address of our new website. You can check out all kinds of great resources there. So let me jump over to slide 2 and let's meet our presenter. Senior Vice President David Frederick is the Director of Wealth Planning here at First Bank, and he's going to be taking us through some pretty interesting information today. All right, let's jump over to slide 3 and bear with me as I read our legal disclaimer. The opinions expressed in the presentation are statements of the speaker's opinion and are intended only for informational purposes and are not necessarily the opinions of First Bank. All right, so let's jump over to slide number 4 and we are ready to dive in. David, take it away.
Thank you so much, Mike, and hello everyone. It is good to speak with you this morning and this afternoon. The objective today is really twofold. Number one, after the election earlier this week, to try to plot out what the federal tax landscape might look like going forward as a predictive matter. And number two, in response to that, what might be some good strategies to help people mitigate their taxes as we try to adjust to a potentially changing tax landscape. So when I was presented with this task of coming up with the idea of how do I project forward, I believe the year 2020 has cracked my crystal ball and scattered my tea leaves, as it has done for very, very many people. So when coming up with the idea of how do I project forward, I decided to approach it like a historian, which is to try to figure out where we've come from by way of a timeline to try to figure out what the timeline might develop into going forward. So we're going to walk through this afternoon a tax timeline that's going to walk through several major periods and events that will have affected federal taxation in the past 10 years or so. The first event is the passage of the Tax Cuts and Jobs Act of 2017. This is often known as the Donald Trump tax cuts. The first area that we're going to look at is pre-Tax Cuts and Jobs Act of 2017. What did things look like under the Obama administration? What did things look like before the Tax Cuts and Jobs Act? We are then going to consider the world after the Tax Cuts and Jobs Act of 2017, up until we get to the United States election of 2020 that took place this past Tuesday. I had rather foolishly thought that it would be likely that I would know the outcome of the election for today's seminar, and that I would be able to present to you based on that election what the outcome might realistically be. We are still waiting to know who the President of the United States is going to be. We're still waiting to hear about several other key races, including the Senate and the Congress. So I am in fact going to present 3 possible alternatives. One is a status quo, that things will continue on largely as they have been before in the area of federal taxation, that things will not change drastically. Number 2 is this idea of completely repealing the Tax Cuts and Jobs Act of 2017 and going back to an era before that law was passed. We'll consider that as a possibility. And then finally, I'm going to walk through Joe Biden's tax proposal, his tax plan proposal, what was on his platform, to say what might happen if, in fact, Joe Biden is the president and has support in the Congress to pass his tax plan. Likely, even with projections like this, the truth might be someplace in between all of these. So this is not a definitive list of what the future might hold. It is some reasonably good guesses at the direction that this country may be walking, but it will lead to some strategies that are of general application. I would also encourage you at the end of this webinar to present me with questions. I'll be handling a lot of topics. I'm going to try to handle them from an eagle's eye perspective. But if you have questions about details or questions for clarification, please do enter them in the chat box and we'll get to them at the end. So let's start with the tax landscape before the Tax Cuts and Jobs Act of 2017. This is really the tax landscape from the 1990s It was changed under the Bush administration in the 2000s, but went back into effect largely in 2012. And this will sound familiar to a lot of people, I suspect. Certainly people old enough to remember what it was like paying taxes after 2012 and in the 1990s. The top marginal income tax rate for individuals was 39.6%. We had the standard deduction as well as a personal exemption, $6,000 for one, $4,050 for the other. And then here's where the real play was with the itemized deduction. We had an itemized deduction that was very generous for all state and local taxes paid. Charitable gifts were deductible to a great extent. The mortgage interest deduction is often considered the cornerstone of itemized deductions, and the medical expenses were largely itemized and could be deducted with a reasonably moderate cap or floor, actually. We also had a top marginal tax rate on long-term capital gains of 23.8%. That's a 20% long-term capital gains top tax rate plus a 3.8% Affordable Care Act surtax on investments. So we call it 23.8%. And finally, Social Security is 6.2% for an employee, 12.4% for a self-employed person, and it's capped on the amount of income that it's going to be taxed on. Earned income back in 2016, it was earned income up to about $118,000. Going on, estate and gift taxes. The estate and gift taxes were adjusted in 2012 on a compromise that followed the fiscal cliff, if everybody remembers the old fiscal cliff. The top marginal rate was kept at 40%, but the exemption amount was expanded. It was based on about $1 million of an exemption. Now it's up to about $5 million of an exemption, and it increases with inflation. So in 2016, it was about $5.45 million for a single person, just under $11 million for a married couple. And there was a lot of room for estate planning and estate planning attorneys to help mitigate that tax. So these are the individual taxes before 2017, and that sounds pretty run-of-the-mill. But here's where the rubber starts meeting the road, and this is when the tax situation before 2017 starts getting serious. The United States had a top marginal tax rate for corporations, that's C corporations, the double tax corporations, of 35%. That was the highest corporate tax rate in the industrial world. Take a look at this. The United States is up there at the top of the graph at the highest tax rate for corporations in the OECD countries. That's the developed countries, the industrialized countries. And our tax rate was higher than France and everyone else. And it became sort of a problem. If your tax rate is higher than France, and not to belittle our French friends, but if your tax rate is higher than France, you have a pretty high tax rate. So this became a problem in the United States. And corporations faced the highest possible tax in the United States, but oddly enough, they only faced the tax on their worldwide income, but only when they brought it back into the United States, only when they repatriated their profits. This created a perverse incentive for companies for American companies doing business across the world to try to keep their profits out of the United States, to try to keep their money out of the United States, to try to keep their investments out of the United States and not invest it in the United States, not repatriate their money. This led to an era of what's known as corporate tax inversions. That's where American companies would purchase subsidiaries in foreign countries and would move their headquarters to a foreign country in an attempt to keep their intellectual property out, their profits out, and work through different structures like that. My favorite example, and one that hits close to home, is Burger King is no longer an American company. Burger King is now a subsidiary of a Canadian company that also owned Tim Hortons. If anybody remembers, around the St. Louis area, there were several Tim Hortons shops that opened in about 2015. They didn't last for very long, but that is a result of this corporate tax inversion. So this created the problem, and it was this problem that the Tax Cuts and Jobs Act was designed to address. Tax Cuts and Jobs Act was first and foremost a corporate tax cut. It was intended to lower the top marginal rate from 35%, the highest in the world, to 21%, which is right in the middle of the pack of the industrialized world. Didn't get it down to the lowest point. Donald Trump was talking about trying to lower it to 15%. The moderate compromise was 21%. It also had what's called a deemed repatriation of profits, which means that when this act passed, Congress deemed as though all the corporations that were housed in the United States that had international profits, it's as though they already brought their profits back and brought them back to be taxed. But there was some tax relief on that. The deemed repatriated profits were taxed at lower rates. It also created a new territorial tax system that said that only profits in the United States will be subject to tax, although there is an anti-abuse provision to prevent gross receipts, companies with gross receipts over 500 million from evading tax as well. So there is a backstop to the domestic portion of the bill. In addition to this tax cut for C corporations, and this may be more relevant for people on the line, to make C corporations, to make S corporations pass-through entities more competitive with the C corps that they are now competing against that have this huge tax cut, Congress also passed a 20% deduction. It's what's known as the Section 199A deduction for S corps and pass-throughs like LLCs and partnerships that are out there competing with C corps. And this was a major deduction that was passed. It's a very complex one, but it is a major one. So the Tax Cuts and Jobs Act comes around largely to solve the corporate tax problem. But in addition to that, largely to sweeten the bill politically so it could pass muster with some more moderates, maybe even get a little bit of Democratic support, although I don't think that it did. There was an attempt to lower some amount of individual income taxes. Now, the individual income taxes were lowered. The top marginal rate went from 39.6% to 37%. Long-term capital gains rates stayed where they were at 23.8%. But all of these tax cuts were temporary, and they will all sunset and go away at the end of 2025 if the tax cuts are not made permanent. Let's take a look at these tax cuts. You'll notice that a lot of the way the tax were cut was in changing the tax rates for the bracket. So while the 10% bracket remained unchanged, 15% went down to 12%, 25% went down to 22%, 28 to 24, etc. And like I already said, 39.6 went down to 37%. Meaning, by and large, there was a tax cut available at the rates, at least, for most people across the country. And yes, people in California already know what you're going to say. I'm going to address it right here. So while there was, in fact, a tax cut in rates for everyone, there was also a couple of changes to deductions and credits. The first was to double the standard deduction, which most taxpayers across the United States take, to double that from about $6,000 for an individual to $12,000 for an individual, and almost $25,000 for a married couple. But in doing so, they also eliminated the personal exemption, which was substantial. And so the standard deduction doubling wasn't quite as generous as it was perhaps made out to be. The Social Security tax stayed where it was, but here is where some of the rub comes in for the Tax Cuts and Jobs Act. The first one and the biggest one, especially for people who live in high tax states, notably California and New York, was that state and local tax deductions were capped at $10,000. So a high income earner in California who pays tens, if not hundreds of thousands of dollars in tax to the state of California can now only deduct 10,000 of that tax from their federal income tax, which, by the way, means that for a lot of high earners in high tax states like California and New York, there was likely a tax increase as this deduction went away. Similar, but not nearly as severe, the mortgage interest deduction was reduced in its applicability. The house that your mortgage interest deduction is grounded on is now no longer allowed to be $1 million in value. It's $750,000, I think. So the mortgage interest deduction gets limited somewhat. But, and this is important for tax planning, the charitable deduction was substantially expanded. People who give cash to operating charities can now deduct up to 60% of their adjusted gross income by giving cash to operating charities. And the the charitable landscape has become much more sophisticated since then, making charitable strategies much more appealing. All right, so one more thing, the estate and gift tax. Top marginal rate stayed at 40%, as it was before the Tax Cuts and Jobs Act, but the exemption base was now raised to $10 million instead of $5 million, also indexing upwards with inflation. There is, in 2020, that's $11.58 million for an individual, just north of $23 million for a married couple that's exempt from estate tax. There is still also substantial room for estate planning strategies. Those strategies remain almost entirely in full force. One thing to watch, though, is that the exemption amount will revert back to its $5 million base in 2026, when all the other individual income tax or individual taxes revert back to their prior state due to congressional budgeting rules. So 2025 is the year to take action if you haven't taken action before. And I would strongly encourage everybody to take tax action and estate planning action now, as opposed to waiting to then, because again, as we'll see, the landscape may change. So that's what taxes looked like before the Tax Cuts and Jobs Act of 2017. We've considered some of the changes that came along with the Tax Cuts and Jobs Act of 2017. And now we get to the election. And the election is still not fully resolved. It's not quite clear who the president will be. I think that Joe Biden has an edge right now, but there's still a lot to be resolved with that. It does also look as though the Senate is likely to stay a Republican majority, but again, things to resolve with that. So I'm going to explore a couple of different options. What might happen with the status quo is maintained, complete repeal, which is not terribly likely, and then we'll explore the Biden tax plan, and then we can take some questions. And then I'll go through some strategies, and then we'll take some questions. So the status quo. As I read my tea leaves, and as I look at my cracked crystal ball right now, I think the status quo for taxes is the most likely outcome for at least the next 2 years until there's another congressional election in the year 2022. I say this under an assumption that Joe Biden may be president, but that the Republicans will maintain control of the Senate and are unlikely to allow Joe to pass his tax plan. The status quo is also hold if Donald Trump, in fact, retains control of the White House with the Trump administration. The status quo, as I see it, is in fact the most likely outcome. That substantial change is in fact unlikely. But we're still going to explore it just in case I'm wrong about how the election resolves later this week or later this month or later this year, God help us. All right, so what about the other option, a direct repeal of the Tax Cuts and Jobs Act? You've heard some people talk about ending the Donald Trump tax cuts, the tax cuts for millionaires and billionaires, the tax cuts for big business. What about a direct repeal? Just it's no longer the law. This is highly doubtful. This would be a tax increase for just about all Americans, certainly a tax rate increase for all Americans. It'll be felt quite a bit in the Midwest, in some moderate and low tax states, although people in California and New York may in fact find their taxes going down if the state and local tax deduction is reinforced in full. But as much as anything, this would go back to the era that we saw before the Tax Cuts and Jobs Act, the era of corporate tax inversions, the era of American companies actively trying to stay out of the United States and keep their funds away from the United States, which was the problem that the Tax Cuts and Jobs Act primarily was trying to solve. Not seriously proposed by any major candidate that I'm aware of. Certainly, the Republican candidate has not suggested this. Joe Biden has not suggested this, and even during the Democratic primary, direct repeal was not on the platforms that I was aware of. So what might be the outcome if Joe Biden were to win, and if the Senate were to go to the Democrats such that the Republicans could not stand in the way of the Biden tax plan? Well, let's identify a little bit about the Biden tax plan and what we know. Some of this is still speculative because the platform was written in broad terms without a whole bunch of really in-depth detail. So some of this is going to be stated broadly. I've also highlighted in italics and underlined some of the major changes that are proposed, but let's focus on what we do know. With the Biden tax plan, there's a new magic number, and that's $400,000 of income. Anybody who remembers the Barack Obama elections of 2008 and largely 2012, there was a magic number back then too, and it was about $250,000 of income, that taxes would go up for people above $250,000 of income and taxes would not go up for people below $250,000 of income. Well, it's the same general principle for the Biden tax plan. He's identified a new magic number, and that's $400,000. It's not clear if that's $400,000 for an individual and thus $800,000 for a household. In my belief, it is much more likely that's $400,000 for a household. So if your household earns $400,000 or more through capital or labor, under the Biden tax plan, you can expect a tax increase. If you're below $400,000, you can expect not to have a tax increase. The Biden tax plan says that if you're above $400,000, the top marginal rate reverts from 37% back up to 39.6%. But then it does a couple of new things. So in addition to the rate, there's a couple of new steps. Number one is to create a new Social Security surtax for people making above $400,000 or households making above $400,000. That's a 6.2% Social Security tax. As I showed previously, currently Social Security is taxed up to a certain level of earned income, and then it gets turned off. The idea being that you're essentially saving into your own government-run pension plan, and that you'll take your own money back when you eventually retire. Here, it's changing the definition of Social Security a little bit, saying for most workers, yes, you go up to $140,000 of earned income, and you pay your 6.2%. Your employer pays the other 6.2%, and then the tax stops. But for people over $400,000 of income, it's just being put on as a value-added surtax of 6.2% starting on your first dollar over $400,000 and going up as much income as you have above that, which changes the nature of Social Security from a savings program to more of a tax and distribute program, especially for people over $400,000. Additionally, itemized deductions are severely limited for people above $400,000. They're limited down to 28% of the deduction's value, which means that if you were to deduct $1, in my reading of it, in my understanding of the proposal, if you were to deduct $1, instead you'd be able to deduct 28 cents as soon as you hit the $400,000 mark. This means that certain deductions that we've relied upon, especially under the Tax Cuts and Jobs Act, the charitable deduction, will lose a lot of its value and a lot of its ability to have effect. The mortgage interest deduction will likewise become curtailed by this, to the extent that people utilize the medical deduction. And if the state and local tax deduction is brought back into full force, which is not clear under the Biden plan, then your state and local tax deduction will be limited by this 28% reduction. It also will phase out that 20% deduction available to S corps, small business owners that have a pass-through entity, a pass-through structure. That was the tax cut that was meant to make the S corps and the pass-throughs more competitive with the C corps, and that will phase out once the company hits $400,000 of taxable income and will eventually go away. This might have a big effect on small businesses that have come to rely on the Section 199A deduction. In addition, people who have over $1 million of income in a given year will have their tax system changed for their capital gains. Currently, long-term capital gains are taxed at a preferred rate, 23.8% when you put on the Affordable Care Act surtax. A preferred rate as opposed to ordinary income, which is taxed at 37% right now, 39.6% proposed. Long-term capital gains are taxed at a preferred rate in an attempt to prevent what's called capital lock-in. It's an attempt to make it plausible and feasible and worthwhile to actually sell your capital assets, realize the gain and pay the tax, rather than just keep on holding them feeling locked into them for fear of the tax. Now, if you are over $1 million of income and you liquidate your capital assets, over $1 million of income, you will not be able to avail yourself of the 23.8% rate, the long-term capital gains rate. You will now be treated as though you're taking ordinary income. This is likely to, this is a rule that's proposed to stop what's called the carried interest loophole, which is too technical to get into right now, but it's likely to have a broad effect, especially for people who are selling assets like the family farm, selling assets like real estate, selling assets like investment real estate. It's going to have a big impact if it comes to bear. When it comes to real estate, it especially is going to have an impact if Joe Biden tax plan comes to realization and they eliminate the 1031 like-kind exchanges. 1031 like-kind exchanges, for anybody who doesn't know, is the ability to have investments in real estate, sell the real estate, and invest in a new piece of real estate without paying any tax on the first sale. It's as though you just traded the land for a new piece of land rather than sold the old piece of land, realized the gain, paid the tax, and then bought a new one. This is a very important provision. Section 1031 is a very important provision for people who invest in real estate and people whose livelihood is made by developing and moving from real estate to real estate. Take this away and it very well might curtail substantial real estate investment. All right, what else do we know? There are some benefits for individuals with the Joe Biden tax plan. Notably, anyone under $400,000 of income, their tax rates will not change. There's also, at the center of his plan, is the idea of the increased child tax credit and child independent care credits. This is credits available for families that have young children, for families that have children under the age of 18, that there's a credit against tax, currently $2,000, raising it to $3,000 for children, or $3,600 for children under the age of 6 under the Joe Biden tax plan. And the credit would be refundable, which means that if you don't have as much income as you have children, you would actually get a check from the government for the amount of credit that you're due above the tax that you owe. Likewise, if you are caring for someone that is not necessarily your child and you're spending money on a caregiver, you're spending money on daycare, adult daycare, whatever it might be, you will have a credit against tax up to $8,000 of spending where it is currently $3,000. So families with children, families below $400,000 of earnings, likely to see a tax decrease from the Joe Biden tax plan. Also, the first time home buyers credit was an Obama era tax credit that was really in response to the collapse of the housing market in 2008, 2009, trying to rebuild the housing market. Joe Biden adds it in here because it was very popular when it was there. And then there's some suggestion that the qualified retirement contributions, your 401ks, your IRAs, which currently give you an above-the-line deduction for those contributions, might be switched to a credit. This is one that I've tried to find a little bit of literature on, and as much as anything, it puzzles tax experts kind of the way it puzzles me. It is probably intended to help people who are lower income make better retirement savings. The exact application of it is not clear to me, and as far as I've read, not really clear to anyone else. But if it's put into effect with some good details, it may very well be a benefit for people under $400,000 of income. One of the things, it's not on the slide, but one of the things that was not mentioned by the Biden tax proposal was the reinstatement of the full state and local tax deduction. So for especially our friends in California, our friends in New York, who are hoping for the reinstatement of that tax deduction, that is not part of the platform as I have read it. So the cap on that is likely to stay in place, even if Joe Biden wins the presidency and the Senate is one that is amiable to his tax plan. All right, corporate taxes. I can do this pretty quickly. Corporate taxes, the idea is to raise the tax from 21% where it currently sits back up to 28%, which is not back to the full 35 where it was the highest rate in the world, but it's a substantial increase. It comes along, though, with a new tax, what is considered a new alternative minimum tax for corporations based on their book income. If they earn $100 million or higher of book income, then there will be a 15% tax. Book income, for everybody who has their own business, as you know, book income is a broader measure than taxable income as it's currently defined. Book income is your income prior to certain expenses, deductions, things that are necessary for the ongoing maintenance of the business. This is going to have an effect not just on how corporations carry on their business with their tax planning. If this tax increase comes in, this new alternative minimum tax comes in, it may very well affect how businesses carry their expenses because they can no longer deduct them against this alternative minimum tax. They may cut expenses, they may cut jobs. It's not quite clear yet. Additionally, there will be a surtax on companies that try to leave, on companies that try to offshore their operations. So offshore manufacturing will face an unstated surtax on, in addition to the corporate tax and the alternative minimum tax. There will, however, be a contrary tax credit for made in America manufacturing. As of now, as of my reading, the surtax on offshoring and the tax credit for made in America are unstated. Exactly how much they are, it's unclear. My guess is that they're likely to be set equal to each other and at relatively low rates, but please don't quote me on that. Estate and gift tax. This is another area where there's going to be a big change. So the top marginal rate is likely to be kept at 40% of the estate tax. Although some reports say the Biden proposal at one point said 45%. But it's likely to reduce the exemption from $10 million as an indexed base per person back down to $5 million where it was before the Tax Cuts and Jobs Act. What this means is each individual would likely have about $5.6 million per person in 2021 if this were to pass on January 21st of 2021, the first day of a Biden presidency. And while the estate tax is kind of a political football that goes back and forth, and estate planners really do plan for things like this, one of the bigger parts that is more unorthodox, that is less planned for, is the elimination of the automatic step up in basis at death for appreciated assets. Step up in basis at death essentially means that if a person dies holding appreciated assets, that upon that person's date of death, those asset bases will be increased to the fair market value of the assets as of that date of death. What that really means is that the person who inherits the assets, whether it's stocks, bonds, and mutual funds, or it's land, or it's something else, can liquidate it immediately following the decedent's death and pay very little or no income tax on it because the basis will equal or come very close to equaling the fair market value. If you take that away, now people who die holding assets will pass them on to their heirs, and it's not clear, but one of two things might happen. One, the heirs will take it with what's called a carryover basis and will have the same low basis that it had when the decedent died, and thus will not likely want to sell it because of the high taxes to be realized, which would create what we already described as capital lock-in. The other possibility, and this one is even a little bit more troublesome to tax preparers or troublesome to tax strategists, is the idea of a deemed realization, which means that when the person who holds the asset dies, it's as though he or she sold it on their date of death, even if the sale was never completed, even if like the land was never sold or the stocks, bonds, and mutual funds were never sold. It's as though they sold it and had to pay, and created the tax upon that sale when they died. This will be problematic for a lot of people that have substantial assets, especially land, especially farmland, that they want to pass on to the next generation, but don't have a lot of cash to pay the tax on a deemed sale of that land. So this is one, this along with the 1031 exchanges being eliminated is really something to keep your eye on as we watch the Joe Biden tax plan potentially come to some proposal. So let's talk strategies. I know I just went through a lot of taxes very quickly. Let's talk a little bit of strategies. The corporate taxes, if you are in fact running a C corporation and the Joe Biden tax plan comes to full fruition, it is likely that the Made in America credit is something that will be worth pursuing. But as I read my crystal ball and my tea leaves, I think that it is also likely that companies go back into a corporate inversion strategy structure. That is assuming that the Joe Biden tax plan allows for offshoring of profits and only taxes them when they are repatriated. If the Joe Biden tax plan creates a higher tax rate on corporate profits and this alternative minimum tax, and by the way, it's worldwide income without a need to repatriate it, I actually think that we'll see a number of substantial American corporations dissolve and reincorporate offshore. That would be the tax advice that would make the most sense on that point. But it's hard to see exactly how the structure would affect American business. Let's talk a little bit closer to home. So individual taxes. If your individual income is under $400,000, frankly, there is relatively little change. If anything, you're under $400,000 and you have several kids at home, you might see your credits increasing in such a way that will mitigate your taxes. If, on the other hand, you are above $400,000 of annual income, it's time to start taking some tax preparation. It's time to start taking some tax strategies. And here's the rub. The people who advised the Joe Biden tax plan were very clever because they both increased the taxes and they decreased the effectiveness of deductions, notably the charitable deduction, at more or less the same time. So whereas under the old plan, under the Tax Cuts and Jobs Act, if I saw a rate increase coming, I would talk to my clients about charitable structures. Again, like I mentioned previously, the charitable landscape has become very sophisticated since 2017, and charitable structures are out there to mitigate taxes in very effective ways. But with the 28% cap on deductions for people above $400,000, you have essentially cut off at the knees a lot of the strategies that go around charities. You've also cut off at the knees potentially some other strategies that go around other deductions. For instance, borrowing to buy your new home. And even if you have S Corps or if you're running a C Corp, maybe the expenses are not as fully deductible as they once were. In which case, the real crux for planning against this tax is all going to do with timing, income timing. And what I mean by that is while your taxes are low, you would want to accelerate your income into the year when your taxes are low. So right now, 2020, Tax Cuts and Jobs Act still in full effect, charitable deduction still in full effect. In fact, charitable deduction has been made better by the CARES Act. You can now deduct 100% in the year 2020 because of the coronavirus. But you want to accelerate your taxes into a year when you have low taxes. For closely held businesses, that might mean investigating a switch between a cash method of accounting to an accrual method of accounting so that you can accelerate some of your income that's expected in future years into 2020 if at all possible. Likewise, if you're an investor, consider taking your capital gains in the present year or pursuing some sort of structured liquidation schedule to restructure your portfolio, to diversify. Don't hold off, because especially if you're at $1 million or above, you might lose some of that long-term capital gains treatment. If you're going to pursue a charitable structure, do so now. Charitable remainder trust, a private foundation, a donor advised fund, lots of great charitable structures are out there. And if you are at all concerned that your taxes may go up under a Joe Biden presidency because of the Senate or not, and you want to be charitably minded with your tax mitigation strategies, start the charitable structure now. Once the Joe Biden tax plan passes, if it does, then your strategy will shift into tax deferral. which is the idea that you can defer tax by deferring income, by deferring payments to you through whatever deferral mechanisms available, qualified contributions to the retirement funds. The idea being that you might be able to outlast the high tax. This high tax is one that, not to be too political, but I don't think would stand up to a Republican Congress or a Republican president. And if you can defer your income long enough, you might be able to outlast the tax. With all of these strategies, I suggest you contact a wealth advisor for more sophisticated advice. One final point when it comes to a gift and estate taxes, a lot of estate planning strategies had been structured around the step up in basis at death. Often when we know their client is nearing death, but his or her family is going to survive them, there are strategies to put assets into his or her name for the purposes of getting a step up in basis and being able to liquidate the strategies after that client has passed away with as little tax as possible. That strategy goes out the door. And if you have one of those estate planning strategies that relies on that, it is time to reassess those step up in basis strategies. It is also likely time to reassess using your full, based on $10 million estate tax exemption while you're alive through a conversation with your estate planner. If you are at all concerned that the Biden tax plan may come to pass, I'd encourage you to contact a wealth advisor to talk about some of the sophisticated estate mitigation strategies, estate tax mitigation strategies that are available, and so that you can pursue some things that may help you mitigate taxes in the long run. I realize that that was a lot of information, and taxes are not a simple matter. So I would encourage you to ask me some questions now, and reach out and contact me through email if you have more questions later. But Mike, I'd like to open it up to questions if you'd like.
All right, fantastic. Thank you so much for that very interesting presentation. So let me remind folks how to submit those questions. In the webinar tool, there's a question section. Just pop that out, go ahead and type your question in there, and we'll go ahead and get that asked and answered. So let me start with one that says, so if it looks like there will be no major changes to the tax laws, do you have any ideas for tax strategies in the status quo?
All right, that is an excellent question. I just got done saying that I foresee the status quo staying in place, and now I just got done talking about a bunch of strategies in case the Biden tax plan comes to be. So let's give a few points on the status quo. Number one, as I think about it, if you have a closely held business, you must pursue the 20% deduction available to pass-through entities, to S-corps, partnerships, and LLCs. I'm not telling you to switch your C Corp to an S Corp because that's a taxable event. But if you have an S Corp or an LLC, pursue that 20% deduction. I think I saw some data recently that there's a substantial percentage of business owners that can avail themselves of a massive 20% deduction that still aren't doing so. So contact your accountant, contact your CFO, and see if that 20% deduction is available to you. Number two, if the status quo maintains, I would suggest people that are looking to mitigate taxes strongly investigate charitable structures. This is not just writing a check to your favorite charity. This is actually pursuing a sophisticated structure like a donor-advised fund, charitable trust, maybe even a private foundation, maybe using your IRA for what's called a qualified charitable distribution. There are ways to benefit charities that can really, under the current tax regime, really help to mitigate your income taxes and your estate taxes while letting you control the assets, while potentially letting you benefit alongside the charity from the income on the assets. And finally, and this is one that I say to a lot of my clients, especially the clients that I love that live in California, that the state and local tax deduction has been reduced severely, and it doesn't look like it's coming back even under a Biden tax proposal. This means that when you retire, it may be worthwhile to look at retiring to a low tax state. California is unique because it is the highest taxed state in the union, and it sits right next door to the lowest tax state in the union. Nevada has zero income tax. And to the extent that you cannot deduct your state and local income taxes in California, if you were to eliminate or mitigate those income taxes, those state taxes, you might actually find that you now have 13% more available to you to spend in retirement. And as a wealth planner, 13% more available in retirement is substantial. So if you're in a high tax state and you're looking at retirement, one of the things that may be beneficial is to look at a low tax state for retirement.
All right, very good. Thank you so much for that. A couple other questions popping in here. Is the $400,000 a year referring to gross or taxable income?
It is referring to what's called adjusted gross income. So adjusted gross income is really it's the man standing behind the curtain when we talk about a lot of tax base. Your gross income gross income means all income from whatever source derived. And it's not usually the tax base because you're allowed to take losses away from it. You're allowed to take above the line deductions away from it, qualified contributions to retirement plans. So we don't usually talk about gross income other than to get us to adjusted gross income. Once you take away those above the line deductions, those losses, those retirement contributions, adjusted gross income then becomes the number that we talk about. And the elimination of income through deductions, through charitable deductions, the mortgage interest deduction is less effective because the IRS wants to stamp you at getting at a certain level of income before you start taking away all of your sort of discretionary deductions. So adjusted gross income is usually the measure that we're talking about when we talk about things like that $400,000 magic number.
All right, very good. Thanks for that question and that answer. Again, a quick reminder, submit a question, pop open that webinar tool, type one in, and we will get that submitted. So another question, it says, okay, just to clarify, it sounds like if you make below 400,000, you're pretty much not impacted. Is that right?
By and large, yes. I would say there's a couple of ifs out there, or a couple of buts. One but is if you're making 400,000, but you are primarily engaged in the business of real estate development, and your business relies to some extent on buying and selling real estate and moving real estate around, the elimination of the 1031 proposal, the proposal to eliminate the 1031 like-kind exchange is going to be devastating. So real estate developers and also farmers and people that live on the land and whose lifestyle depends on potentially buying and selling land as they develop their farming industry. Number two, the automatic step up in basis at death affects more people than we would think. We would think that it's something that millionaires and billionaires with their millions and millions of dollars in assets, that they're the ones that really benefit, and they do. But think about things like the family home. Again, to bring it up, things like the family farm. When once mom and dad have passed away, you're going to sell the farm. That automatic step up in basis of death affects a broader array of people than certainly than the estate tax, and much more so than just a $400,000 sort of cap. So it is a big change, and it's one that is likely to have a big effect. But I will agree with the questioner that if you're under 400,000, there are no stated tax increases, certainly no rate increases, or new taxes that are likely to come your way. And in fact, there will be child tax credits and dependent care tax credits, along with the first-time homebuyers tax credits that are likely to increase.
All right, very good. Thanks so much for that. Another question says, based on the large stimulus expense from the CARES Act, when would we expect to see tax increases to pay for that $600 billion stimulus package?
All right, so I wear several hats, and one of my hats that I've worn is I'm also sort of an armchair economist. I have a master's degree in economic history from London School of Economics. I say that only because I'm going to answer the question half as a tax guy and half as an economist. On the one hand, the real answer to your question is we will see a tax increase when interest rates on government debt starts increasing. So right now, the Treasury note has a record low interest rate because people who are seeking return and seeking stability from around the world and around the country pump their money into T-bills. As long as the debt is extremely cheap, the United States federal and can be maintained by the government, the United States federal government has very little interest in raising taxes to pay down that debt. It's a rolling line of credit, and one with a very low interest rate for the United States federal government. Once that does start increasing and the debt starts becoming more and more expensive and the deficit starts growing at a faster and potentially unsustainable pace, then I think that we could see tax increases coming along with it. That's one answer. The other answer is, and this is not the position of First Bank, this is not my position, I give you every disclaimer I can. There is a evolving theory of economics in the world called modern monetary theory. And modern monetary theory is kind of like a hyper version of Keynesianism, if you know what Keynesianism is. Modern monetary theory says that certain countries, and potentially only one country, which is the United States, can essentially print money as much as it wants without ever really having to stop. That it can in fact monetize a lot of its debts, which means that if it owes $1 million, it can just print a new $1 million. This is based on the idea that the United States has a special position as the international reserve currency, that all sales around the world in oil and other commodities are denominated in American dollars, that America has a highly sophisticated payment system and structure in place, and that the United States dollar is unlikely to collapse because of all of its insulation, being the international reserve currency and with the payment structures. As such, if it's not going to collapse, and we're not going to fall the way that the Weimar Republic did in Germany in the 1920s, or the way Argentina has done a few times in its history, we might just keep on pushing out more and more cash into the system. Now, it depends on who you are as to whether you think that that's a sustainable idea or not. But that idea is coming more and more into vogue in the halls of Congress. We've seen some Congress people cite to it. Some economists have weighed in on it. Some Nobel Prize winning economists have said, yeah, it might work. So if that idea does in fact become more and more in place and the interest on our debt stays low, it's possible that there will never be it's possible that we won't see a substantial tax increase for a good long time.
All right, very good. Appreciate that. Another one says, many advisors have suggested moving away from 401k pre-tax to Roth IRA after tax due to the expected tax increases. What are your thoughts there?
The analysis of whether to go into a traditional IRA and thus a traditional 401k, traditional 403b, et cetera, or a Roth IRA is in fact a very simple analysis. If you know that you are in a higher tax situation right now and will be in a lower tax situation in the future, it is better to use a traditional IRA. Take the deduction right now, let the money grow, and pay the tax later when you're in a lower tax position. If you know that you're in a lower tax position right now and will be in a higher tax position in the future, it is better to use a Roth structure. Pay the tax now while it's low, let the money grow free, and take it out free when you retire. The general knowledge, the orthodox knowledge around that distinction usually comes from the fact that people who are earning money are higher taxed than people who are retired. People who are earning money are earning their salary and their bonus and et cetera, et cetera. And while you're earning money, you're likely to be in a higher tax bracket. And when you retire, you're likely to be in a lower tax bracket. So if you're high taxed right now and low tax in the future, you're better off with the traditional structure. However, if you know that you're in a lower tax position now than you think you will be in the future, or you know you will be in the future, because of deductions, because of net operating losses, because of other things that will mitigate your taxes right now, because potentially Joe Biden will raise your taxes if he has the Senate to do so in the future. If you know that your taxes are going to go up, even though you might be retired, then yes, the Roth structure makes more sense. So it's really an examination of, are my taxes higher now, or are they going to be higher later? One more time, just to say it, the rule is high taxes now, low taxes in the future, use the traditional structure. Low taxes now, high taxes in the future, use the Roth structure.
All right, very good. This has been fantastic. Let me just give one last call for questions. If you have one, go ahead and type that in real quick. Let me just give you kind of a moment to do that. It looks like we have them covered. So David, let me do this. Let's go ahead and move to the last slide here. I do want to just do a quick wrap up, and if a question comes in before I end, we'll go ahead and take that. But I just wanted to give everyone a quick heads up. Our next session is actually going to be on November 18th, and we'll feature our partners from Brown Smith Wallace covering the topic of zero-based budgeting to strategically plan and manage costs. And we're going to send an invite out for that pretty soon. Do keep an eye out for it. All right, so let me just look one more time here. Okay, I think we're good to go. So David, I'm going to go ahead and wrap us up. I want to thank you all for joining us today. A special thank you to David for his time and expertise. Really fascinating. I learned a lot. I know that. And if all of you could just take a few moments to complete a brief survey that's going to pop up as soon as you exit the session, that's going to help us improve our service to you. With that said, have a great day, everyone. We'll catch you next time.